Right now, AI data centers and the electric vehicle transition are pushing global copper demand 50% higher by 2040. At the same time, global copper mine production is expected to peak within the next 4 years. That means demand is accelerating, while supply is not keeping pace. Some analysts are warning of a substantial shortfall in supply as early as 2026 and warn that could deepen for decades. And if that happens, copper doesn't just rise slowly, it reprices. So, in this video, I'm going to walk you through 4 copper ETFs you can use to get exposure to this theme, why copper demand is exploding, and some risks to be aware of. Copper is basically the wiring of modern life. Power grids, EVs, renewables, data centers. Let's start with AI. Modern AI systems don't just need chips. GPUs are connected using dense copper cabling because copper is still the most reliable and energy-efficient conductor for short-distance, high-speed data transfer. As AI scales, copper usage scales with it automatically. Then you've got EVs. A traditional petrol car uses around 40 pounds of copper. An electric vehicle uses anywhere from 88 to over 180 pounds. So, demand isn't coming from one trend, it's coming from everything at once. Now, here's the problem. You cannot just make more copper. From discovery to production, a new copper mine takes well over a decade to develop. That's why analysts are calling this a structural imbalance. So, if copper really is heading into a long-term supply squeeze, the question becomes, how do you position for it as a stock market investor? There are 2 broad ways to get copper exposure via ETFs. 1. ETFs that track the price of copper itself, usually via futures, and equity ETFs that hold copper mining companies. These behave differently. A futures-based copper ETF tends to move broadly with the copper price. Mining ETFs, on the other hand, hold shares in mining companies and may also pay dividends. Let's get into the ETFs. The first is WisdomTree Copper ETC, COPB. This is the cleanest copper exposure on the list. COPB tracks the price of copper itself using futures contracts. If copper prices rise, this ETF rises, and vice versa. The fund manages around $1.8 billion in assets and the expense ratio is 0.49%. COPB is domiciled in Jersey and is structured as an exchange-traded commodity or ETC, which means it's technically a debt security, not an equity ETF. In simple terms, you're not owning copper directly, you're holding a note issued by the provider that tracks copper prices. This ETC is for investors who believe copper demand will outpace supply. Prices will rise higher over time, and they want exposure without company-specific risk. But there are trade-offs. Because it uses futures, they can be low cost. There's no dividend, and long-term returns may lag spot copper prices. So, think of COPB as pure macro exposure to copper. Now, let's look at the miners, starting with Global X Copper Miners ETF, COPG. COPG invests in large established copper mining companies. These are producers with multiple mines, global operations, and strong cash flow when copper prices rise. The expense ratio is 0.65%. and the fund manages around $7 billion in assets, making it the largest ETF on this list. Now, the risks. Mining stocks are inherently more volatile than copper prices themselves. They're also exposed to geopolitical risks, things like taxes, labor disputes, and regulation. And because these are equities, they can still fall during broader stock market sell-offs, even when copper fundamentals remain strong. That said, this is the most diversified miners ETF on this list. COPG holds mainly large cap miners, many of which also produce other metals. That diversification helps reduce volatility, but it also means less pure copper exposure. So, with COPG, you're getting the broadest basket of miners, lower risk than the pure play ETFs, and more stable exposure to the copper theme. Next, Sprott Pure Play Copper Miners ETF, ticker COPP. This ETF tracks the Nasdaq Sprott Copper Miners Screened Index and focuses exclusively on pure play copper companies. That means no diversified miners where copper is only a side business. The fund also allows limited exposure to physical copper. Because of that pure play focus, COPP is far more sensitive to copper prices than the other ETFs on this list. and that also makes it far more volatile. Alongside established producers, COPP includes companies that are still developing mines and early-stage explorers that don't yet generate cash flow. That's where the upside comes from. If copper shortages materialize and prices rise, these companies can re-rate very quickly. But the flip side is risk. If copper prices fall, pure-play copper miners like the ones in this ETF tend to fall harder. COPP currently manages around $253 million in assets with an expense ratio of 0.65%. COPP is a high-conviction copper bet, the most aggressive copper ETF on this list. Finally, iShares Copper Miners ETF, ticker MINE. This ETF tracks the stock's global Copper Universe Index and holds a global basket of copper-focused mining companies. Compared to COPG, MINE has higher copper purity, less exposure to diversified miners where copper is only one part of the business. Compared to COPP, it has less small cap and early stage exposure, with most holdings in large and mid cap producers. That's why MINE sits between COPG and COPP in terms of concentration and risk. MINE currently manages around $493 million in assets, with an expense ratio of 0.55%. This ETF suits investors who want focused copper exposure but don't want to go fully aggressive into small cap miners and explorers. Now, let's talk about what could go wrong. First, China. China consumes more than 50% of global copper. An economic slowdown would hit copper prices. Second, a global recession. If global growth contracts, copper demand can fall sharply in the short term. Third, mining ETFs can be volatile. If you want direct exposure to copper as a commodity and you're comfortable with futures, COPB is the cleanest pure play available to UK investors. If you prefer owning companies with operational leverage to rising copper prices, plus all the usual equity risk, then COPG, MINE, and COPP sit in the copper miners basket, each with a slightly different angle. Copper is becoming one of the most important materials in the global economy. And when something becomes unavoidable and supply can't keep up, it doesn't stay cheap for long. If this helped, please like and subscribe. Thanks for watching, and I'll see you in the next one.